On Point with Craig's Investment Partners.
The information provided here is general in nature and it's not financial advice. It doesn't take into account your situation, objectives, goals, or risk tolerance. All investments are subject to risk and none are guaranteed. Before you make any decisions, we recommend you contact an investment advisor. For more information about our services in that regard, or to view the Craig's Investment Partners Financial Advice Provider Disclosure Statement, please visit our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Morning team, hope you're all well. Look, before we start, I feel like I should acknowledge the events at the Mount over the last several days. Just really tragic stuff. I live in Tauranga. I can actually see the Mount right now out my bedroom window looking across the harbour, and I've lived in this part of the country for the last 25 years, so it's just awful what's gone on there. So our thoughts and our sympathies really are with everyone that has been affected by that tragedy. Talking about financial markets seems a bit trivial in the wake of starting on that note, but it is my job, so let's crack into it. Last week was another eventful one across New Zealand and elsewhere. The S&P 500 index in the US posted its second weekly loss in a row. It was down 0.4%. Most other markets around the world fell slightly too. Emerging market equities were the only major one to buck the trend. Emerging markets were up 1.1%. Here at home, the domestic NZX 50 index fell 2%. So that was quite a tough week, the worst actually since late 2024. And that sees the local market down 0.7% so far this year, in contrast to other markets which have all gained this year. And it's EM and Japan leading the charge. Local interest rates jumped last week. We saw a stronger than expected inflation report. We'll talk about that in more detail shortly. So the local 5-year swap rate was up 19 basis points, finished last week at 3.72%. And we saw at least one local bank bring forward its forecast for the first OCR hike for this cycle from next year to late this year. So that was interesting too. A lot of movement on the currency front as well. The US dollar had another difficult week, its worst week actually in 8 months. I think it was down 1.8%, the US dollar index. And that, in addition to that hotter inflation report we saw here in NZ, saw the Kiwi rally 3.4% against the greenback. So we're at the highest levels since September, about 59.5 cents against the US dollar. Right, let's talk about some of the key releases we saw, and we'll start here at home. We'll work in chronological order. So last Wednesday morning, we had the latest global dairy trade auction results, and it was more good news. We saw the headline GDT index rise again. So after that big rise in early January, 6.3%, that was the biggest in almost 5 years, we saw the index rise another 1.5% last week. So that sees prices back at levels we haven't seen since November, and those are the first back-to-back increases since August last year. So remember, last year was quite a tough year for global dairy prices. They were down about 17%, and we saw Fonterra cut its milk price forecast twice through the back end last year, once in November, again in December, and it now expects a range of $8.50 to $9.50. If we see prices continue to rebound, then maybe with a bit of luck things will end up a little higher than that. So that was the dairy auction. We also had a housing market report, and the market finished last year in a pretty subdued state. This report covered December. Not a whole lot of movement on the pricing front, and volumes as well slipped back a little bit. Look, that's not to be unexpected. December is always a quiet time. People are on holiday and so forth, so sales volumes slipped 12% from the previous month. One piece of good news was that the days to sell declined. It slipped from 42 down to 39, so we're in the 30s now. That is a positive sign for the market. It shows that properties aren't sitting on the market for sale for quite as long. Prices still pretty subdued. Like I said, the house price index down 0.6% for the month, so prices finished 2025 marginally lower. Hopefully, we will see house prices a bit more stable in 2026, and the market will pick up a little bit on the back of an economic recovery, slightly lower mortgage rates, and falling unemployment, all things that we're hopeful about for the year ahead. Now, the big release here in New Zealand came out on Friday, and this was the Consumer Price Index, the CPI inflation report for the December 2025 quarter. It was stronger than expected. The headline inflation rate increased at an annual rate of 3.1%. So markets were at 3.0 and the Reserve Bank was at 2.7. Now, those Reserve Bank forecasts came out in November, so all the economists out there have had the luxury of seeing some of the more recent data and upping their forecasts. So that's why they were at 3 versus the Reserve Bank at 2.7. But at 3.1, that's a little hotter than even what the economic community was expecting. And importantly, it's also now above the top end of that RBNZ target range. Their target range is 1 to 3%. So they were right at the top of that range before. Now they've pushed just above it. So that does make things a little uncomfortable. We haven't been above that range since the middle of 2024. So this won't completely alarm the Reserve Bank, but it really is a reminder that inflation is still a concern and that cost of living crisis is far from over. So the Reserve Bank meets next month, middle of February, and we won't see any change to the OCR, but we will be watching their comments and their tone very closely because financial markets are now pricing 51 basis points of tightening. That means increases this calendar year. So you look out to the September RBNZ meeting and financial markets see about an 80% chance of a hike at that time. So the view has really turned over the last few months and people are now saying the hikes that are inevitable because we're at the lows, the hikes are probably a late 2026 story rather than 2027. That's the view of financial markets. Banks are still divided. Of the 5 big banks, the 4 Aussie ones and Kiwi Bank, I think 2 out of those 5 are picking a hike before the end of this year, but it was only 1 out of 5, a week ago. So watch this space. Further afield, we got the global flash PMIs for January. PMI stands for Purchasing Managers Index. These are activity indicators. This was one of the first economic indicators of the new year, and we got some good news. All regions started 2026 the way they finished last year, which was comfortably in expansionary territory. The Aussie PMI jumped to a 5-month high. Its Japanese counterpart increased to the highest since August 2024. The UK PMI hit the highest since April 2024, and Europe and the US were pretty steady, but all of those were comfortably in expansionary territory, all comfortably above that break-even 50 level. So pretty much good news all round. There were a few signs of a softer economic environment in the US, for example, forward orders, in part due to falling exports. They were down a little bit and job growth was a little bit stagnant. So it wasn't 10 out of 10, but definitely very solid across the board. On the central bank front, we had the Bank of Japan, and geez, there's been a lot going on in Japan of late. I actually recorded a podcast episode a week or 2 back about what's been happening in Japan, and it was a bit of a history lesson and a look back to what's been going on there over the last few decades. So if you want a refresher on the Japanese economy, then maybe start with that one. But last week, the Bank of Japan left interest rates unchanged. So their policy rate, their OCR, sitting at 0.75%, super low to us. But for Japan, that is the highest since 1995, a long time ago, more than 30 years ago. That was the year the Warriors entered the NRL, wasn't it? It was an 8-1 vote, so there was one person that said, actually, I'd rather hike, so that was interesting. And the commentary also talked about the inflationary outlook, how there was a little bit more pressure there. So markets definitely took this as a bit of a hawkish tilt, even though there was no change. So markets see 2 more rate hikes this year from the BOJ, 57 basis points in total. So we need to watch Japan closely this year. There's a lot going on the political front. There's a lot happening in bond markets and interest rate markets, and the yen's moving around. The 10-year Japanese government bond yield increased to almost 2.4% last week, which is again low compared to bond yields in New Zealand or the United States, but in Japan, that's the highest we've seen since 1999, and that's all come on the back of higher inflation, better growth, political changes, expectations of more stimulatory policy, and the central bank being able to normalise interest rates. So that was the Bank of Japan. Looking to the week ahead, it will be another very busy one, and the main event will be the first Federal Reserve decision of the year. So the outcome is set to be announced at 8 o'clock in the morning on Thursday here in New Zealand. There's no summary of economic projections this time, so all we'll get is the statement and then the press conference with Fed Chair Jerome Powell. Now, nobody expects a change this week, so the Fed will be on hold. However, there is further easing expected from the Fed this year. 44 basis points is priced in right now. So that's in contrast, isn't it, to what we're seeing from a couple of the other central banks around the place. Remember, I said here in New Zealand, markets now see hikes over the back end of this year, and in Japan they're in the process of normalising interest rates, so they're moving up as well. And across the Tasman, hikes are on the cards. We'll talk about that shortly too. But the Federal Reserve is still expected to keep reducing interest rates, but they won't do that this week. Now, Powell's comments will be very closely watched, especially after that Department of Justice probe and the pressure from the Trump administration on Powell to reduce interest rates more quickly than he wants to. So there's a lot going on. Remember, Powell's term as Fed chair ends in May, and polymarket odds at the moment are favouring BlackRock executive Rick Reeder to be nominated by Trump as his successor. Now, Reeder was sitting at about 3% on Polymarket a couple of weeks ago, and he's jumped right up to 50%. So he's above Kevin Warsh, who was the leader, a week ago. So we'll wait and see how things shake out. But more interestingly, Powell could actually stay on as a governor until 2028. So his term as Fed chair ends, but his term as a governor doesn't end until 2028. And usually, if you are replaced as chair, you move on completely. But he could stay if he wanted to. That would be unusual, but not completely unheard of. Mariner Eccles was the last to do that. That was back in the 1940s, and he did that to help protect Fed independence while the Treasury were trying to fund those post-war debts. So, you could see a situation where Powell's term ends as Fed chair, he is replaced, but he hangs around as governor until 2028. I think that'd be pretty funny, actually, because it would kind of annoy the US administration. Also, don't forget that it was Trump who put Powell in his job. He nominated Powell to succeed Janet Yellen, who was his predecessor, and the Senate confirmed him in January 2018. That's going back to Trump's first term, and that was a 4-year term. You always get a 4-year term, and then it was Biden that reappointed Powell for a second 4 years. So interesting stuff, but that will be the key event of the week, that Fed decision, which is released on Thursday morning here in New Zealand. A couple of other central bank decisions this week, one out of Canada, one out of Sweden, so we'll be watching those too. On the economic front, we will get a few things out of the US. The one I'll be watching will be the Conference Board's Consumer Confidence Report. That's a notable one. Across the Tasman, we'll be watching the December inflation report, and that's interesting because we've got an RBA meeting across the Tasman next week, I think it is, the first one of the year. And at the moment, markets see a pretty good chance of a rate hike. That is priced into the tune of about 60% next week from the Reserve Bank of Australia. We've seen inflation stubbornly high. In November, it was at 3.4%. Markets expect it to slip back this week to 3.3%. Those will be the December quarter figures, but that is still hotter than the RBA would like. We also got some very strong labour market figures last week out of Australia. The unemployment rate dropped to a 7-month low of 4.1%. That's down from 4.3%. People were expecting it to go up to 4.4, went down to 4.1, and you saw a real surge in employment that was well above market expectations. So you've got an economy that is actually going okay over there. You've got quite stubborn inflation, even more stubborn than what we're seeing over here, and people are talking about a hike from the RBA. So that will be really interesting in the first week of February. So I think that inflation release is out on Wednesday. It'll be 1:30 p.m. on Wednesday afternoon, and that will be the key release to watch across the Tasman. Here in New Zealand, we will get the ANZ Business Outlook Survey for January. That is out on Thursday, 1 o'clock, and this will be interesting to watch. Obviously, the December ANZ Business Outlook saw confidence hit a 30-year high, so we'll be watching that, see if we can sustain those levels or what it tells us about how the year has started. Also, mortgage lending figures for December will come out of the Reserve Bank, and these will be interesting too because it looks like, with the benefit of hindsight, that optimum time to refix your mortgage was November-ish. So I'll be interested to see how many people fix their mortgage in December and for what sort of term ahead. So that will be interesting. Thursday, Friday, Business Outlook from ANZ, and then RBNZ mortgage lending. Finally, last but not least, there's a lot going on the corporate reporting front. The international earnings season picks up this week. I think you've got a little more than 100 S&P 500 companies set to announce results, including 4 of the Magnificent Seven. We've got Meta, Microsoft, Tesla, and Apple all reporting results this week, and they represent sort of 14, 15, 16% of the index, the S&P 500 by market cap, so a pretty chunky group of 4, isn't it? They're not the only ones. Plenty of other big global companies reporting: LVMH, ASML, Starbucks, Caterpillar, Visa, a couple of the big oil companies, Chevron and ExxonMobil. So something for everyone there. And in my written report that I put on our website for clients, there's a full calendar if you want to know exactly which day they are all reporting. All right, team, thanks for listening. Enjoy your weekend or your long weekend if you're in the part of the country that is lucky enough to be enjoying one, and we will talk again soon.
For more insights, visit craigsip.com.